When you first dive into the world of investing, you'll run into one of its great debates: growth or value. In a nutshell, value investors are looking for stocks that are underperforming their true value. When they pop back up where they belong, they carry their value investor with them. Growth investors are looking for companies that will, grow. They may not sound that different, but there's a lot more to the debate than that. As a new investor, though, you probably only want the answer to one big question: which one is right for you? What is value investing? The value investor is the bargain hunter of the investment world. They prowl the market for companies they believe are woefully undervalued, and they swoop in and snatch up shares. Basically, value investors want to buy into companies that are good but misunderstood. The goal is to hunt down securities that will jump up where they belong any day now, and when they do, they ride that rise all the way up. But the reasons a company gets to be undervalued are complicated, sometimes subjective, and myriad. Maybe a legal ruling didn't go their way, maybe some world event hit their sector, or maybe the economy as a whole took a dive and dragged them down with it. Whatever the cause, sometimes a solid company is going for a lot less than it's worth. Now, a smart investor knows the value of research. No matter how brilliant you are or how closely you're following the stock market, going with your gut alone is a good way to go from cocky to broke. A good value investor isn't going to just guess whether a company is undervalued. It's all about comparing the current price to the fundamentals. They'll look for a low price to earnings ratio or high dividend yields. Maybe the price of the stock is below its book value. Or maybe they just see high cash flow and robust revenues. When they have a good grip on how the company is actually performing, they compare that to what the market says it's worth today. If the gap is big enough and in the right direction, they'll invest and wait for the market to realize it's a mistake and reward them. If, on the other hand, they discover the market has it right and the price should stay low, well, then they're back on the hunt for a better target. What is growth investing? By contrast, growth investors chase securities with high potential for fast, aggressive gains. Maybe that potential is due to high market demand in their niche, a new, exceptional product, or top-notch management that knows just how to navigate a competitive arena. Again, wise investors try to move past gut feelings by looking at fundamentals, like a company whose balance sheet shows exceptional growth before it shows up in their stock price. You might expect every growth stock to be an up-and-coming company making its way from obscurity to world beater, and many of them are just that, rising stars with innovative ideas or practices with enormous potential that just haven't broken through yet. A surprising number of growth stocks, though, are already industry leaders, but they've managed to position themselves just right in their sector to eat up even more of their market. Just look at Amazon. Whatever kind of potential growth stock you think you found, it's important to remember that big, brilliant bet they're taking that's impressing you so much, well, it's still a bet, and those don't always pay off. If it doesn't work out, or if the company stumbles stepping up to that new level, the bottom can drop out and take your returns with it. Value versus growth stocks. What are the differences? Even though the two strategies are only meant to be ways of choosing what to invest in, typically the two kinds of investors act differently in other ways too. Growth investors usually enter and exit their positions faster. They want to grab hold of a rocket just before takeoff and jump off when the flight slows. They're not day traders, but they may hop in and out over the course of a few years. On the other hand, value investors are usually in it for the long haul, maybe holding on to a stock for decades. Even though the difference between the two isn't about what to do with your stocks, but which stocks to choose, there's a good reason they lead to different behaviors. The real power and risk of growth investing is targeting a stock just before it explodes in value. Once that explosion is done, you've gotten what you wanted, and it's time to find your next big thing. Value investors want to get in on a company for less than it's worth, and once they have it, they take their time reaping the benefits. Everything we've talked about leads to other differences too, like risk level. Typically, value stocks are considered less risky, as even if they take a dip, they're unlikely to keep falling. Growth stocks are both riskier and more generally volatile, with their growth spurts, skyrocketing prices, and vulnerability to bad publicity. Prices. The point of value investing is targeting stocks, usually from established, successful companies, that you think are temporarily underpriced. Growth stocks, even for young companies, can be quite expensive and might be priced above their current fundamentals. The point isn't that they're cheap, it's that you think the company is positioned for so much success that the price is worth paying. Dividend payments. Dividends can be an underappreciated part of investing, but value investors don't miss it. Slow price gains hurt a lot less if the company is paying you just to hold their stock. Growth investors are a lot more likely to miss out on this passive income, as growing companies probably want to take the money that would have gone to a dividend and plow it into expansions and investments to grow the company still further. Growth stocks versus value stocks, which is better? Well, that really depends on you, the investor. How much risk are you willing to tolerate? What time span are you working over? Questions like these make a huge difference in shaping investment strategy. But this also isn't a binary choice. If you see a stock and after looking at the numbers, you're sure that price dip won't last, a little value investment can do the portfolio good. And if you see a company and you think it's sure to be the next big thing, growth investment returns can make your year. Typically, value investing is better for the risk averse with longer time horizons. While you can't set and forget any portfolio, those who prefer to rebalance only once or twice per year may feel more comfortable owning value names. If you have the capital to eat bigger losses, you can afford to chase bigger returns, and growth investing might be just what you're looking for. Remember though, no strategy is guaranteed, and if you lean this direction, you'll need to watch your portfolio a lot more closely, and even then, be prepared to lose more for the chance at big gains. Anytime you invest, it's important to ask yourself questions like, what do your finances look like? What kind of market do you think you're operating in? And how can you mix strategies to make the most of those factors? Examples of value stocks and growth stocks. Whether a stock counts as growth or value is subjective. In fact, it's possible for a stock to be both based on fundamentals and market behavior. For instance, when a stock's price climbs into the hundreds, you might think of it as a value stock. But if the underlying company is still growing, it can still count as a growth stock, even if it's a titan of the tech industry. Value stocks may include Apple, Bank of America, Citicorp, GM, Merck, Verizon. Notice how most of these growth stocks are tech-based? In the modern market, that's no accident. Growth stocks may include Alphabet, you know it as Google, Apple, Chipotle, Meta, that's the parent company of Facebook, and Nvidia. Notice how Apple made both lists? That too is no accident. Are growth stocks riskier than value stocks? Typically, growth investing is considered the riskier of the two approaches. While your results are only ever as good as your picks and your luck, it is true that growth stocks are meant to be high-priced, fast-growing companies, but that does carry an oversized risk of crashing and burning. On the flip side, value investors are basically looking for companies that have already had the crash, or at least a downward drift, and will be bouncing back soon. Any strategy can succeed or fail, but since growth investors target companies that will either launch or explode, the gap between the two outcomes means the risks are higher. Historical performances of growth and value stocks. It's important to remember the effect of context on the two styles of investment. When you consider their performance, results vary across sectors, timeframes, and market conditions. In hot, growing economies with low interest rates and rising company earnings, growth stocks do well. If that circumstance changes, they can easily stumble. Value stocks tend to reverse that, holding their ground when the economy shrinks or is in recovery. Some essential value stocks like grocers or healthcare companies may even resist falling while all other stocks are dropping. Overall, you can think of the two a bit like this. Value investors like to bet on the elephant that just had a little tumble. Growth investors want to bet on a cheetah that's barely started to run. In other words, growth and value stocks may net the same returns in the medium term, but in a short-term sprint, growth stocks tend to win, and when it comes to long-term returns, it's hard to beat value picks. Bottom line, which is better? If you're just starting out, you should probably play with both. A diverse portfolio is always advisable, and within your risk tolerance, taking advantage of both types of stock can generate the best returns long-term. Plus, a well-balanced portfolio has a potential advantage of smoothing out the biggest bumps in the road. Overall, both methods have their merits and their moments. It's best not to be too dogmatic. Using either or both has its advantages. By mixing the two to match your goals, you can make the most of what the stock market has to offer.